ladies and gentlemen. It's a great pleasure to be back here at FHS and back in Abu Dhabi. So as Gemma told you, I'm going to talk about the numbers, and we're going to begin with a look at global performance. We're going to start with occupancy, August year-to-date, 2023, and then the percentage change to 2019. Now, I do a lot of presentations, mostly in Europe, admittedly, and the general picture across the world is that from an occupancy perspective, we're nearly, but not quite back to full 2019 levels. But we've got two exceptions. You can see there Central America's doing very well, but also here in the Middle East, 1% ahead of where we were. And that 65% figure, as you can see, fairly in line with the rest of the regions. But when you consider new supply, which is something that I'll talk about shortly, you'll see that that 1% growth in occupancy is actually no mean feat. But if we look at a slightly longer occupancy trend, here you can see 2019, 22, and 23. And of course, there's some movement for Ramadan. You would expect to see. The story here, I think, is the last couple of months. Very much in line over those 3-year periods. There's not much movement. Most of the regions still playing catch-up, but here, very much aligned, signaling a full recovery and something of a normalization of the industry. Average rates on a global level. A lot has been said, of course, about average rates over the last couple of years and just how quickly they have recovered. And we can see that across the board, they're up on 2019. Now, you have got some pretty extreme numbers there, down in South America, also in Northern Africa, but I think that's really the inflationary environment that we see in Argentina and Egypt. But if you remove those two regions, you can see there, the Middle East is right up, along with Europe, 30% up on 2019. And note, $187 US. The Middle East commands the highest rates of any region in the world. But let's now move and look at the Middle East as a standalone. Occupancy, average rate, RevPAR, year-on-year percentage change. Of course, again, some shifts for Ramadan, some shifts for Hajj, exactly what you'd expect to see. But elsewhere, really, over recent months, we've seen an incredibly strong performance there. You've got double-digit RevPAR growth across many months of the past 12. And I think this really points to exactly what the region's all about. It's about economic strength, of course, that entrepreneurial spirit that we see here. If we look at the 10 biggest sovereign wealth funds in the region, $4 trillion US under management, that's only just smaller than Germany, the 4th largest economy in the world's annual GDP. And that strength filtering through into the numbers quite nicely. But I mentioned supply. And this is incredibly important, I think a really key slide. This is the supply indexed on 2019, so how supply has changed in the last 4 years. And we can see there in Doha, it's up 34%. In Dubai, 27%. In Al-Khabar, 22%. Riyadh, 20%. These are significant supply increases. But if you look at those latter three that I mentioned, you'll see that demand is outpacing supply. So we're still getting occupancy increases despite significant supply growth. A couple of markets, a little bit softer on the demand side. There you can see Kuwait City and Manama as well. Potentially not all of the corporate demand recovered. Also, potentially some Saudi visitation not back to the levels that it was. But if you look across the board, all of that new supply coming in, but actually the supply-demand equilibrium for this region really quite healthy. Now I want to show you a series of maps. And we've got here occupancy indexed on 2019. So most, but not all, are back up above the levels that they were previously. You can see there that's led by the holy city of Medina, doing very well. Mecca, a little bit further behind, but ultimately 9% supply growth there, and obviously a far bigger market. But you've also got there Ras Al Khaimah, Dubai, back up above where they were. And I think this really, again, points to the Saudi and the Emirati markets really driving this region forward. Kuwait City, a little bit further behind, as is Doha, but you'd expect that, of course, with the increase in supply as a result of the World Cup. But if we look year on year, I think this is a really important slide and a really positive one as well. Now, of course, Doha is down. We all know why, World Cup driven. But elsewhere, we've got some really strong double-digit increases. And it's led by a market many of you wouldn't expect it perhaps to be led in. Salalah down in the south of Oman, beautiful market, 41% occupancy increase year on year. But look elsewhere, Ras Al Khaimah, 23%. The holy cities, Mecca and Medina, doing really very well also. But where those markets aren't increasing by quite the same level, single-digit increases, not too concerning. One, it's still growing, of course, and secondly, I think this is more of a normalization of the market. We're not going to see these double-digit growth numbers for much longer as we are fully, basically, recovered. Rate-wise, it's a bit of a mixed picture, but for the most part, fairly strong. Admittedly, maybe not up at the same levels as we see in some other parts of the world, but we've had some decent growth there. And again, you can see the holy cities doing really well. Obviously, religious tourism coming back very strongly. And then here in Abu Dhabi and Dubai as well, 17% ahead. So once again, the Saudi Emirati market's really driving that business forward. If you look year on year, though, it's a bit more of a mixed bag. We've got some declines, and I think partially that is maybe a slight correction in the market. They've obviously, a lot of these cities have seen a real boom in average rates. To see them step back ever so slightly, maybe not too much of a concern overall. But we've still got some good news cities, good news stories even across these markets. You can see, once again, I keep mentioning them, but the holy cities, incredible growth year on year. Here in Abu Dhabi, finally getting rid of some of that lower rated COVID demand and able to push rates very strongly. And we can also see Riyadh continues to go from strength to strength, and Muscat in Oman is also coming back. So there's plenty of good news stories out there as well. Moving on to the actual performance. Actual Occam rate year to date. And it's no surprise to see, again, Saudi and Emirati cities at the top of this leaderboard. This is ordered by occupancy. And Dubai, ever strong, of course, leading the way at 76% occupancy year to date. In terms of rates, the strongest rates, well, it's all about the Kingdom of Saudi Arabia. $220 average rate in Jeddah, $215 average rate in Mecca, $213 in Medina. Very strong levels of rate. And even Kuwait City, which is struggling from an occupancy perspective, always strong average rates there, 196 year to date. Obviously, all of that contributes to the reason why the Middle East has the strongest rates in the world. And going forward, business on the books for the next 90 days versus the same time last year. Now, of course, you'd expect to see Doha down, of course. It had the World Cup last year. That's natural. But Riyadh continuing to power forward, Abu Dhabi up 2%, and then in Dubai as well. Significant increases. Of course, we've got COP28 coming at the end of November, beginning of December, up to 80,000 delegates arriving for that. And all of them, of course, bringing their very own carbon footprint with them. But that's another story, I think, for another day. Last slide before we move on to look at development and the pipeline. And this is looking at class across the region. And on the left-hand side, you can see occupancy and average rate, percentage change to 2019, August year-to-date of 22. And then the right-hand side, you can see August year-to-date of 23. Now, in terms of last year, you can see we weren't back recovered from an occupancy perspective. Where we were nearest to recovery was in those middle classes, and rates were being driven, as we've seen across the world, by the top end, by luxury. If we look this year, quite interesting to see actually, that 1% growth that we saw at the beginning of this slide is being driven predominantly by upscale, upper mid-scale, and mid-scale classes. Their occupancy is back, luxury and upper upscale not quite there. But once again, average rates, as you can see, it's really at the top end of the market, has really driven those rates forward accordingly. And of course, this region, as we all know, is very well known for its high-end products. And if we move to look at the pipeline, that is going to continue. So what we've got across the Middle East, we're currently tracking at STR 589 active projects in the pipeline. That equates to 151,000 keys across this region. And you've got the supply number here, then the light orange bar at the top is the numbers in the pipeline, and the percentage is the percentage that existing supply will increase if all of those projects open their doors. So you can see the growth is happening once again at the top end, a 51% increase in luxury, very little growth in mid-scale and economy. I don't think that's particularly news. This region, of course, is known for its high-end product. And that's been the case. Over the last 13 years, you can see the supply in the mid-scale and economy hasn't really moved at all, but we've seen significant increases the further up the class scale you go. But where are those rooms in the pipeline going to open? Now, this is our global leaderboard. So US and China you'd expect to see in top 2, of course. But number 3 in the world in terms of pipeline is Saudi Arabia now, 95,000 keys. You can see there the UAE is also on our chart, 34,000 keys in the pipeline across the Emirates. And just off the chart as well, just behind Mexico, is Egypt. Not GCC, of course, but MENA, so I thought worth mentioning a further 26,000 keys in the pipeline in Egypt. But when you get down to the city level, I think that's where it gets even more interesting. So Mecca is the city with the largest pipeline in the world. 25,000 keys. Mecca is number 1. You then see London, and then Dubai, number 3, at 23,500 keys. But half of the 10 biggest markets are in this region, as you can see, because it's joined by Doha, Riyadh, and Jeddah. So I think just underlines why this region is so important in the global hotel development arena. But if we look at those numbers, number of rooms in the active pipeline, you can see there we've got those big 5 once again, but then still really significant growth to come. Medina, Cairo, 8,000 keys. Ras Al Khaimah, Muscat, just under 5,000 keys. But look at the percentage increases if all of those rooms open their doors. Particularly in Saudi, you'll see a doubling of supply in Jeddah, 65% up in Riyadh, 50% up in the holy cities and in Al-Kabar as well. Huge amounts for the market to absorb. And if we look at the class, this is the same chart that we saw previously. You can see it's not happening in the mid-scale and economy, as we know. It's all at the top end of the market, more than a doubling of supply in luxury. And of course, a lot of this is happening in the cities that were on the previous chart, but a lot of this is also happening in the giga projects. And if we look at, for example, if you look at Diriyah Gate and you look at the projects in the pipeline currently, we're tracking 8 projects in the pipeline, all of them luxury. And if you look at the brands as well, it's Capella, Corinthia, it's Four Seasons, it's Park Hyatt, Rosewood, Taj, Langham, Ritz-Carlton, really strong names, luxury brands. That's where the growth, as we know, is going to happen in the kingdom. But we will need these rooms, because if we look at some data from our good friends at Tourism Economics, this is international arrivals into Saudi Arabia indexed on 2019. And of course, the biggest influx and increase is going to come from the Middle East and Africa, but overall, a 220% increase in international arrivals. So if this demand is fulfilled, we will absolutely need those rooms. Now, just to finish off, I want to have a look at the forecasts. And at STR, we currently forecast for Dubai and Abu Dhabi, so we've got an aggregation of those 2 markets. And this is demand indexed on 2019. And it's good, it's about 25% up. But look at how it compares internationally versus European markets, Asia-Pacific markets, US markets, significantly ahead, underlying the strength of those 2 cities. And then again, if we just look at them alone, this is the aggregation year on year, RevPAR, moving forward, as you can see, split relatively evenly between occupancy and average rate. You'll see the scale. We're not talking big numbers here, but we're talking solid, normalized historical levels of growth year after year after year as we move forward, as these 2 markets continue to prosper. So to summarize, new normal. We've seen a real boom period. We're now seeing things potentially settling down a little bit more, but the market's, in the most part, still doing very nicely. opportunities abound. We know what's happening here in the Emirates, Vision 2030 in Saudi, of course, the strong economic situation, sound geopolitically, lots and lots of opportunities for the region. But there are risks, of course, there always are. And on the face of it, you'd look at the pipeline numbers, and you think, well, that's a bit of a risk. But we've been talking about supply growth in Dubai now for the last 15 odd years, and it still goes from strength to strength to strength. I think potentially a greater risk, whilst economically very sound here, maybe not so much in some of the feeder markets, and that could have a knock-on impact. But of course, one thing's for certain in this region, as with any other, candidly, is there's going to be lots and lots of changes. But of course, STR will be here to bring you that very latest data and keep you all up to speed with what's happening. And with that, I will say thank you all very much indeed and have a good conference. Thank you.
Thank you to Tom. Tom, before you leave us, just wanted to ask you perhaps one question. You touched upon there some of the disruptors. Is there anything that could impede demand? Is there any kind of game changers on the horizon? Because we've seen, you know, the sound performance of the Middle East. Anything that could disrupt it?
I mean, you can never tell the future, obviously. There could always be some disruptor out there that we're not expecting. But I think I talked about a lot of the things that are obviously driving the demand and driving the performance. I think, if anything, the biggest disruption will likely happen not necessarily here, but in Europe, for example. You know, it's going to be those feeder markets. We see, you know, economic challenges. You've got countries on the verge of recession. Interest rates are high. All of those things potentially will impact demand, both from a corporate and from a leisure perspective, which is, of course, important across this region.
Sure. I also noticed on your presentation, the bar chart looked quite big for the independent hotel side of things. You mentioned, obviously, the luxury, you know, the big brands and the chains were going to do very well. Anything from the independent brand point of view?
So you are right. The independent, I mean, that was the biggest bar on the chart. And I think with the way we work things at STR, we will understand that a project is there, it's been signed, and we will include it in our pipeline. The likelihood is, particularly in this region, a lot of those rooms will be branded. Just the flag hasn't been put on the project as of yet. So I would expect to see a consistent pattern across those independents once the majority of them get branded. But of course, there is always room for independents. We will see some coming through, but this is a brand-heavy region, and I think if you look at the pipeline, it's only going to become more brand-dominant in the future as well.
Thanks, Tom. Appreciate that. Please give Tom a big round of applause. Thank you.
Thank you.